Welcome to the Enhanced Strategy webcast. I'm John Wilson, the Managing Partner at Ninepoint Partners and the Senior Portfolio Manager on the Enhanced Strategy of funds. I want to spend some time today taking everyone through how we see the current landscape, what that means for equity and other risk assets, how we're positioned in our fund, and where we see some of the opportunities to make further capital gains for our clients lie. And I'm going to start by talking about the core of what we do at Ninepoint Partners, which is to target asymmetry, trying to maximize reward for the level of risk that we take with our clients' capital. That's inherent in virtually all of the strategies that we run, and certainly it's at the core of running the enhanced strategies. If you look over the last number of years, in fact over the past decade, there's been a sea change in the amount of volatility that has occurred in markets. The slide looks at the number of days where the index fell at least 2% on that day, and this is for the S&P 500. Those gray bars coming down represent those days, and as you can see on the left-hand side of the chart, around that 2008 period, it's almost all gray. There were lots of days when the index fell 2%. But over the past decade since we've emerged from the financial crisis, that does happen on occasion. It's not an everyday event, obviously, but over the course of a year, that'll happen a number of times. That has basically stopped happening for the past several months, and in fact, we've just set a number of records for the longest period the stock market has ever run without a 2% decline from its peak. In fact, the last 2 days we've had a pullback, but still within that 2% limit. We've set another record for the longest run without a 5% decline from the peak. We're setting another record for the longest run without any 2% down days. So all of this just speaks to an environment where the market has obviously been moving higher to new records, but it's been doing it in a way that supports a feeling that there is really very little downside in the equity market. And that's, I think, over the long term, probably a dangerous thing, but over the near to medium term, it's quite a supportive thing. It gets people engaged in the market, it lets them take more risk, and it generally is what pushes us to our final highs. One of my favorite quotes in terms of understanding where we are in the market cycle comes from a fabulous investor named Howard Marks, arguably one of the best high-yield investors of all time. And an excellent writer if you ever get the chance to read his monthlies. But he's often asked how he does such a good job of timing the credit cycle and knowing that when to buy when things are cheap and when to sell when things are expensive. And his answer, if you read through this quote, is effectively, well, I don't forecast. You don't need to forecast. All you need to do is look around and look what current conditions are. Are people wildly optimistic or are they wildly pessimistic? Are they jumping to get into every new novel investment scheme, or are they unwilling to even listen to them? Are prices and earnings ratios high in the context of history? Are yield spreads tight or generous? And I think we could all agree that we're clearly tipping towards one side of the ledger on all of these factors. And that doesn't mean that the market is ending. It just means it gives you a great indication of where we are in the market cycle. And I like to think of the market cycle as the roller coaster ride. Certainly if you look back over the last 150 years, this is generally how the equity cycle has run. I'm not at this point saying that we're at the euphoric stage near the top of the ride, but I do think we're approaching there. We've certainly passed through the thrill stage with people getting excited over new, novel opportunities, concept opportunities like pot stocks and Bitcoin and cryptocurrencies and blockchain. Those are the types of things that often happen late in the cycle and are at that point where people are very engaged with risk-taking and very much less engaged with the concept that things could go badly for them. So in our view, we're still on the way up, but approaching the top. And that, generally speaking, is your point of maximum financial risk. If you think about how you want to run money, it obviously changes depending on where you think you are in that cycle. And on this slide, I've shown two extremes. If you think of the last cycle we went through, clearly the bottom in March of 2009 on the left A very difficult time to put money for work. Fear was at its maximum. And if you were to put money to work at that point, and I was in that cycle putting money to work at that point, what you needed to have available to you were, one, you needed to have capital. So you had to have raised some cash at some point along the way so you could put it back to work. But number two, you needed to have the nerve to do that. And that, it's easy to look back and think that was an easy time to put money to work because everything was so cheap. But I can tell you in the moment, it was a very difficult time to put even a dollar to work. And similarly, if you looked at the other extreme, the end of the prior cycle in October 2007, looking backwards, the characteristics you'd want to have had at that point were to be cautious, to be very selective in where you were putting capital, and obviously to have very strong risk controls. Easy again once again to say, but at the moment, at the time, everybody's engaged. The market's going higher. It seems easy to make money. It's very difficult to tell people that they should be looking at risk and being a little more selective. The reality is, over the course of the cycle, you generally don't spend much time at either of those extremes. You're usually somewhere in the middle. We do think we've veered towards the right-hand side of that graph. I'm not saying we're at the peak. I'm not saying you want to get all your money out of the market. I'm not saying we're at maximum risk. And in fact, you'll see in my later slides, we're still relatively bullish for the remainder of 18. But we're clearly skewing towards the later stages of this run. So we're going to talk quickly about the macro background to that landscape. And generally, this is usually true when you're enjoying great run in the equity market. The later stages of the bull market, generally things are going pretty well, and certainly that we think that's true economically. The global economy is effectively made up of four major regions: the U.S., Europe, China, and Japan. And all four of them are really synchronized in terms of accelerating their growth right now. Canada, obviously not as big or important as those other four, but since we all live here, we always pay attention to it. And it also has been doing quite well. So, the Canadian economy, over 4% growth in the second quarter and 3% growth in the third quarter. 7 of the past 8 quarters, over 3% growth. The U.S., as we all know, has been running over 3% the last number of quarters. And now has tax reform as a tailwind to push growth further in 2018. Somewhat, hidden from the major headlines is Europe, which has accelerated to 2.5% growth. That's a number that people would have thought impossible a few short years ago. That's its fastest growth in over a decade, and unemployment is also approaching decade lows. Similarly, China, which many people became bearish on a couple of years ago. We're talking about growth rates by this point getting down into the low single digits. 2017 actually came in about 7% growth, and now the forecast for 18 is another 7%. So we're growing in China well ahead of where people's expectations were a couple of years ago. And finally, Japan, which has been, of course, mired in a multi-decade quasi-depression, is now growing over 2%. In fact, at 2.5% in the third quarter, and actually hit 4% in the second quarter. So a very strong domestic demand in Japan, and actually pretty good strength in corporate profits as well. So a really synchronized, strong global economic backdrop, which is supporting growth and optimism in equity markets. So our big picture view for 2018, is bullish, and that's not just because we had a great start in the month of January, and even with the last couple of days pulling back, it doesn't really change our view. The reasons that are out there that support our bullish view are, first of all, we don't think earnings revisions have been strong enough yet. In other words, earnings estimates still have to come up to catch up with the impact of the U.S. tax reform. And we do think that can be a tailwind to equity valuations. In as much as the Bank of Canada and the Federal Reserve have been slowly raising interest rates, you have to remember that on a global scale, central banks are still very accommodative. Our interest rates are still very low. Now, they're even lower in Japan and Europe. And in fact, in both of those constituencies, they're still printing as much money as the U.S. Federal Reserve had done in its last cycle. So we're still in a money printing world with very low interest rates, and that's obviously supportive of asset prices. I just talked to the synchronized global growth dynamic, which again builds optimism and gets the bullish spirits going in terms of future earnings estimates. And finally, in sync with that, we've had a weaker U.S. dollar, which helps boost multinational earnings as those earnings are translated back to domestic U.S. reporting, and also very supportive of commodity prices. So we think all of that is supportive of a pretty good market run in 2018. Things that would make us more cautious, the big one really is related to trade. Recently, the Trump administration instituted tariffs on solar panels and appliances, but that was widely seen as just their first move in what has been a lot of rhetoric about becoming more aggressive with their trading partners. And certainly from a Canadian perspective, NAFTA is a major risk. So that is something we're watching very closely. That does have major impact, not just on earnings estimates and foreign exchange, but on economic growth generally around the world. Now, if you go a little further through 2018, it's not all bread and roses. We do think the rising rates that are underway right now could end this equity cycle late in 19 or early in 20. In particular, if you look at the bond market, it has been continuing to underestimate rate hikes from the Fed. And over the last couple of weeks, we've had 10-year yields in the U.S. really start to move higher and break through some important technical levels. But if you look out on the future, it's really out in 2020 where there is this big disconnect. The Fed fund futures I have here are discounting 2% at the end of 2020. In fact, they've moved up over the last week to about 2.25% at the end of 2020. But the Fed dots, these are the projections from the actual Fed governors when they issue their minutes, are running well ahead of those estimates from the bond market. Now, the bond market was generally much more conservative on rate increases than the Fed. And for 7 years coming out of the last crisis, they were correct, and the Fed was not able to raise rates as fast as it hoped. But for the last year and a half, actually, the Fed has been right, and the bond market has been the one that's had to raise its views. So when we look at 18, we do see 3 rate hikes this year and possibly 4. But importantly, we see another 3 or 4 in 19, and that's a dramatic difference from where the Fed fund futures are. We do think the European Central Bank will begin to taper the QE program this year and then can start towards a tightening program in 2019. Eventually, and this generally is what happens, higher rates will eventually invert the yield curve and cause a recession, and that, if you look from a timing perspective, looks more like a 2020 event. And certainly, as I mentioned earlier, a trade war initiated by the Trump White House could accelerate that downturn. So with that, I'm going to talk about our fund. I just want to remind everyone about our objectives. Number 1 is risk. We are there to protect against large drawdowns, regardless of market conditions. So, a bear market is not an excuse for us. We run a protection scheme that is there designed to try and minimize drawdowns within a reasonable level. From a return standpoint, our goal is to generate positive returns that are non-correlated to the market and that compound year over year. And finally, from a volatility standpoint, we do understand that for many investors, the journey is as important as the destination. It's fine and dandy to say you could triple your money in investment, but if the ride is too crazy, most people won't make it to the end point. So we do try and manage that ride and maximize the amount of return people earn for every unit of risk that they take. From a portfolio standpoint, most people use us as their core allocation. We're in that category where we attempt to generate a reasonable level of return at low risk. Historically, bonds performed a lot of this role, but that has much more difficult to do in a world where interest rates are at secular multi-decade lows and are rising. And so we feel we can play an important role in diversifying people's risk away from straight equity funds. Our strategy doesn't look like the market. I think this is important for people to understand. Several of our funds come in a mutual fund offering. And so people tend to just compare them to other mutual funds that are long-only stocks. Our fund is quite different. We do hedge currency. About half of our allocation is in U.S. stocks. And foreign exchange is a source of risk, just like stocks are. So we do hedge that risk. We'll talk a bit about the market risk protection. So we do own downside protection on the market to help offset market declines. We don't look at allocation either at a sector or a stock level as a relative weight to what is in the index. We only look at it in terms of how much risk is in that allocation. So, for instance, our sector allocations are designed based on the volatility of the sector and how much risk that presents to our fund. Finally, we do use options on individual positions as well to improve the risk reward over top of what we would be able to do just owning the stock itself. So, just to give you a sort of flavor for how that all works, I've shown a slide here that what would happen in our portfolio if the market's rising or if the market's falling. We'll start, obviously, if the market's rising, which is what has been generally happening. We'd expect to make gains on our stock positions, which would add gains to the portfolio. And then we would also expect to lose at least some of the premium we'd paid to own the downside protection. Think of it as an insurance policy that just expired worthless. And so the net of that is we expect to make money, but generally not as much as the market in a rising market. Now, in a falling market, we also expect, our stocks in a falling market, generally most stocks go down, so we'd expect to take losses there. But the wonderful thing about using options is, like an insurance policy, they pay off far in excess of the amount of premium you pay if something bad happens. And those gains historically have largely offset, if not entirely offset, the losses we've earned on our stocks. If you want to take a slightly closer look at how that works, I've shown, starting on the left, and imagine I had a portfolio of one stock and a put to protect the downside. I show the initiation on the left, and there's really three scenarios that can happen. The first one, the next column over, is what happens if the stock goes up. Well, we make money on the stock. The value of that put declines a little bit. We still make money overall, so still a pretty good outcome. If the stock goes down, then we lose money in the stock, but the value of the put goes up a lot, and that largely offsets the losses we took on the stock. And finally, if there's no change and just time goes by, then we evaporate the premium on the put, but the stock remains the same value. So it just gives you a much less volatile experience and one that helps avoid those anxiety-causing large declines that the market historically has done. So our current view is basically based around these factors. First, we think energy is perhaps the best value opportunity in the marketplace right now. We're not big energy investors historically. We don't feel like we always need to be there, and we generally aren't. But crude oil markets have stabilized. Crude oil bottomed at $25 in the beginning of 2016. The Western WTI crude price is now sitting around $63, $64, and Brent up around 67 or 68. So clearly far above where we were. And the actual producers, E&P producers, especially in Canada, have lagged tremendously the move up in oil. And generally those stocks are discounting that the oil price is going to come back below $60, in fact closer to $50, and we think that is incorrect. So energy for us is an interesting opportunity, much more volatile than other parts of the market, but a tremendous value play. Similarly, we think financials, in particular U.S. financials, are a great opportunity. They've had a nice run since the tax plan was announced. That tax plan, we think, is incredibly positive for U.S. banks. One, they get a much lower domestic tax rate. Two, it is stimulative to U.S. growth, of which they've got leverage. And three, as we're already seeing, is pushing rates higher, which is positive for U.S. banks. So we do, it is our largest allocation, as we'll see in a minute, and U.S. banks are a big part of that. We also think, by the way, Canadian banks will benefit from stronger rates and firming oil prices as well. From a market perspective, the S&P 500 for us, it's hard to see the multiple going a lot higher here. The multiple's actually come down a little bit, even as the market's risen, as the earnings estimates have come up even faster with tax reform. But at 18 to 19 times this year's earnings estimate, forward estimate, you're probably not going a lot higher. You maybe get to 20. What really takes the market higher from here for us is 8 to 9% earnings growth in the S&P, and in fact, our early indications are it could be even a bit higher than that. So we think that's an interesting opportunity. And finally, the dollar. As Canadians, we're always concerned about what happens to our exchange rate. Globally, the U.S. dollar has been weakening as people around the world witness this global synchronized growth dynamic. global equity markets around the world are actually outperforming the US equity market. And so you're seeing the risk on trade happen as people take money back out of the US and where it was held to be safe and move it back to their domestic markets to get more risk on. That has helped the Canadian dollar. Also helping the Canadian dollar is the fact the Bank of Canada has been following the Fed, generally with a lag, but it can't get too far behind the Fed on the rate increases. Certainly, firmer oil prices and commodity prices can take the Canadian dollar higher. And the big risk we would highlight is NAFTA. That is a massively important trade deal for the Canadian economy. And if Trump was to suddenly announce that he was pulling out of NAFTA, you'd expect the Canadian dollar to have a very sharp and meaningful decline overnight on that news. So the key elements of our portfolio are the market hedge, our equity book, and some of the option structures we use to improve our risk reward. Looking at the market hedge, I mentioned at the start of our presentation that volatility has remained very low. In fact, it was establishing all-time lows as we exited 2017. We stayed there for the start of January. Recently, with some of the pickup in volatility, we've moved from about a little over 9 on the VIX, which measures volatility on the S&P, up to about 14. So that's a pretty meaningful move. 14 over the long term, frankly, is more of an average low. Like that's not a high level of volatility at all. That would be a normal low, frankly, somewhere in that 13, 14 range. So we've come off depressed levels. We're sitting at a more normal level, which makes the purchase of our put options a little bit more expensive, but does give us other opportunities in terms of managing risk in our equity book, which we're going to talk about in a minute. So I've shown our curve. Most people in our fund have seen this curve before. What we show here on the graph on your left is what would happen if you had an index fund. That's that diagonal purple line showing the market return. So if the market goes up, you make money. If the market goes down, you lose that money. Our curve is the blue line, which tries to track as close as we can on the upside, although we obviously do have that premium cost, which hurts us a little bit. And then on the downside, as our insurance policies kick in, it'll cap our losses and eventually keep us from going down. So the cost of that protection book last year was well below the historical average based on those low readings and volatility. Generally speaking, we're usually around 2.5% a year invested in our protection book. Last year was under 2, which was very good for us. This year is trending back higher, not maybe all the way to 2.5, but certainly back over 2. And our current portfolio, actually, we've been rolling our protection. So we have protection out to February, and we're rolling new ones out to March and April. Our equity book, I mentioned earlier, financials is our largest weight. Some of the key names there: Bank of America, Commerce Bank, and Manulife. I also mentioned energy. That's our second biggest weight. Some of the names there: Suncor, which is for us a great Canadian operator and hedged against big swings in the oil price because of its downstream operations. We also own Parex, which is a Colombian producer that's got no debt, generating 15 to 20% growth and very strong cash flow. In fact, its CapEx program is within its own cash flow. And that's leveraged to the price of Brent, so we really like that name. We've also got some exposure to the drilling side with Precision Drilling, the maintenance side with Shawcor, and a Canadian producer with Crescent Point. Beyond that, and there's no really heavy allocations. We do have an option allocation to Europe using the HEDJ. It's a wisdom tree ETF that tracks the biggest companies in Europe with hedging out the euro. Some other big allocations for us are the industrial allocation, where we've got Northrop Grumman, a defense stock in the US, Union Pacific, and Air Canada on the transport side. I'm just going to quickly mention healthcare. We do have a big position in United Health. That's one of our bigger names. It's done extraordinarily well for the portfolio, very strong earnings growth, and still a reasonable multiple. That sector did get hit yesterday on the announcement by JP Morgan, Berkshire Hathaway, and importantly Amazon, that they were going to look at how to enter healthcare for the benefit of their employees. We think that's wildly preliminary. There have been many companies that have talked about this. Almost always it gets ignored. The big development obviously was saying, the minute you put Amazon in a sentence, everyone gets worried. But they're really not talking about insurance. These companies are all self-insured anyway, so it really shouldn't impact United Health. They're really talking about using technology to get at the big costs in the business, which are largely hospitals and doctors. I'm going to finish with a quick comment on energy. Just a slide showing how much worse the energy stocks have done than the price of oil. And, one of the challenges for us is that presents an appealing opportunity, but we're also very conscious that energy stocks and commodity stocks generally can be wildly volatile, and that presents risk in our portfolio. So we are always looking for ways to access reward while managing the risk. I'm going to finish with a quick example of how we can do that using options. We implemented this strategy in our portfolio, which was to get exposure to the XEG with a call structure that allowed us to replicate the upside. You can see the blue line is us, and the purple line would be just if you own the XEG outright. The blue line lags a little bit as the XEG moves higher, but eventually, it stays pretty close. And if you get a big move in the XEG, which is largely what's happened, we come pretty close to the same return as if we just own the XEG. But on the other side, if we were wrong and oil had gone back down and the XEG had declined, we take 60% less downside with our option structure than if we had owned the XEG. So for us, that's incredibly important in terms of being able to put return into the portfolio, but do it in a way that doesn't take the same amount of risk as just owning the equity outright. So I'm going to close with some final thoughts on reasons why we believe the market can go higher. And then it wouldn't be me if I didn't give you some reasons to worry. So I'll finish with those. But first, why the market can go higher. Well, we talked about tax reform. When we go through company earnings and where analysts are, on balance, we still think U.S. estimates still have to come a bit higher. Certainly the fourth quarter earnings season is helping that. Analysts have been waiting to get guidance from companies, and so we are seeing that number start to move up. But that is positive for the equity market. We talked about growth accelerating and the falling U.S. dollar, which is also very beneficial to taking risk. We really don't see an imminent recession either here in North America or globally. So again, you don't need a recession to have a bear market, but you always have a bear market when you have a recession. So it's a good idea to keep an eye on whether you're having a recession or not. We talked about accommodative central banks. I started with this comment, but it sounds a little counterintuitive. I do think sentiment is becoming aggressive and greedy. We've seen that with the pursuit of Bitcoin and some of these blockchain IPOs. That is, over the long term, that's what becomes necessary for people to take too much risk and eventually cause the next bear market. But that can last for a while, and it certainly supports more risk-taking in the near to medium term. And so we do think that's a bit like rocket fuel right now. The final point I'll make is that in his State of the Union address, Trump has been introducing this idea of a $1.5 trillion infrastructure plan. I think politically that's going to be difficult to get agreement on, but it is still possible, and the market will at least consider that it might happen and consider that further fiscal stimulus. So those are all reasons to push the market higher. Reasons to worry, and I hate to be a downer, but these are things that we need to think about all the time. First and foremost, the accelerating growth we've talked about and this tax plan, which is very stimulative, does give cover for the Fed to become more hawkish. And the market's already behind the Fed and where the Fed's sitting now. And if they become more hawkish, it'll be even further behind in terms of where rates are going. And that becomes particularly problematic when you look at, the market's just a little bit different than the Fed for 2018, but it has a much slower rate of increase as you move into 19 and 20. And that difference starts to become much larger once you get out into those years. We do believe rates will keep moving higher, and a rising cost of capital eventually surfaces credit excesses. That's what happens every cycle. It's just a question of how far the rates have to move up and how long it takes, but there, through a big bull market like we've had and an easy credit cycle like we had, there will be capital that was allocated poorly, and as the cost of that capital rises, those investments will roll over. Turn in that credit cycle will ultimately usher in the next recession. If you look at it from a timing standpoint, that's probably in 19 or maybe 20. As I mentioned, an initiation of a trade war would exacerbate that recession, and that was something that people will look back on and wonder why we did that. And finally, and perhaps most importantly, we don't need to have a market crash. I think after 2000 and 2007, everyone sort of anticipates that the next decline is going to be some seminal market crash again. I actually don't think that would necessarily be the case, other than one problem, which is markets have become quite fragile. We've got very thin levels of liquidity. We have large amounts of capital tied up with baskets of stocks that imply a level of liquidity that may not be there with ETFs. We have massive amounts of capital in the market today being traded automatically with program trading. And we have a lot of capital that is short volatility, in other words, betting that markets won't go down. So all of that, if some shock were to happen, could make the next decline worse than necessary. Think of a flash crash, only bigger this time. And on that cheery note, I'm going to wish you all a Happy New Year, and I hope to speak with each of you soon. Thank you.